if it starts to become significant in that market, people are looking for yield. They'll reallocate from something else that's not very interested in the treasuries or fixed income or something, right?
Yeah.
So I think that makes it more scalable, but it could, it could cause it to be a bit harder to go big. But there is some advantage to being big, which is they get into stock indexes that benefit from passive flows of people making regular savings that get dropped into like an index fund.
Right.
So I think Sailor is, with MicroStrategy, they're in one of those index, but there's another target coming up, which, they need a certain number of quarters of profitability and size, and they get in there. So they may get into it soon.
Adam Back begins by highlighting an eye-opening figure, a $200 trillion arbitrage opportunity. This staggering number represents the global pool of assets, ranging from sovereign debt and corporate bonds to dormant corporate cash, that are effectively being eroded in real terms due to inflation and financial repression. He argues that Bitcoin offers an escape valve, a lifeboat for capital trapped in value-destructive environments. Corporations that seize this opportunity early have a first-mover advantage, and the mechanism for doing so is what Back calls corporate capital arbitrage. This arbitrage isn't a short-term trade. It's a strategic transformation of treasury management, wherein companies replace fiat-denominated reserves with Bitcoin. And importantly, these moves are not being executed quietly. Unlike traditional arbitrage strategies that rely on secrecy to remain profitable, this one is publicly encouraged and openly taught, most notably by Michael Saylor through annual conferences and playbooks.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
If you take the 200 trillion, that is the size of the arbitrage, and then that's an enormous amount of money. So you can look at the treasury companies as one of the vehicles to arbitrage that future, because they've got, while Bitcoin's going up, they can bring forward corporate capital mechanisms and buy that at a discount, and their actions are also applying pressure to Bitcoin, probably bring that period forward, so kind of accelerate, hyper-Bitcoinization, basically. So from that point of view, I think it's very scalable, and you can see that Saylor, was very relaxed about getting other people. He has an annual conference where he tries to encourage people and provide the playbook and explain the accounting rules he used. It's got a bit simpler now with the spot ETFs for companies to use those even. But, clearly he's not feeling it's competitive in terms of, for people who are doing an arbitrage, sometimes they're trying to keep it quiet because they know that it's not very scalable, and if other people pile in, it'll disappear. But here it's an enormous dislocation. So it's like the arbitrage of the century, basically. I mean, I think there is an effect, which is that strategy is a bit indexed to the MNAV you can hold. So if you have a higher MNAV, if the MNAV is 3 rather than 2, when you sell shares or sell convertible notes, it makes it more accretive in Bitcoin per share per dollar in. And that's partly where MetaPlanet and OldBG have an advantage, which they have a high MNAV. And so when they do a corporate action, whichever version, it's more effective like that. So it's a little weird because it's kind of sort of self-reinforcing. It has a high MNAV. The high MNAV helps it keep a high MNAV because the corporate actions. So that factor is one thing that makes people skeptical, but they do need a fundamental to get it to the high MNAVs and earn it, like justify it and keep it, because they'll drop and then they'll come back. So there is something fundamental there. So, but anyway, I think it's enormous, and so that's the scalability question. And the other one is sort of sustainable. Can these companies maintain their yield? Can they keep doing it, or is that just going to droop? And one theory for why it might fall is as they get bigger. If you take something very small, they can create a 50% return. Start with 1 Bitcoin, you can buy half a Bitcoin, and now they have 50% return in one shot, right?
Easy.
So that's true, but once it gets going and it's 100 million versus getting over 100 billion in Saylor's case, they have, I think their ability to raise is somewhat scalable with their size, right? Because, sort of the debt ratio, right? If they're both targeting a 1.3 debt ratio, 100 million guys, they can raise 30 million, and 100 billion can raise 30 billion. And Saylor is doing it. He is bringing in larger amounts of money in bigger chunks.
Yeah.
And, I guess the other question is, like, do they start to exhaust the arbitrage players and the bond market, the competition, right? But those markets are very big.
Yeah.
And the convertibles are extremely attractive for those traders. They're the best, the best upside, the best volatility product on the market for their strategy. So I think ultimately, if it starts to become significant in that market, people are looking for yield, they'll reallocate from something else that's not very interested in the treasuries or fixed income or something, right?
Yeah.
So I think that makes it more scalable, but it could, it could cause it to be a bit harder to go big. But there is some advantage being big, which is they get into stock indexes that benefit from passive flows of people making regular savings that get dropped into like an index fund.
Right.
So I think Saylor is, with MicroStrategy, they're in one of those index, but there's another target coming up, which, they need a certain number of quarters of profitability and size, and they get in there. So they may get into it soon.
Zooming out back paints a sobering macroeconomic backdrop, with most major economies facing a prolonged era of financial repression, where inflation outpaces interest rates. Holding fiat reserves becomes a guaranteed loss. Companies with massive cash hoards are slowly waking up to this reality. There is a fiduciary obligation to preserve shareholder value. At some point, Back argues, more tech-focused companies with younger leadership will be forced to confront the Bitcoin option. He hints that there are already internal discussions happening within tech giants like Microsoft and Apple, even though proposals for Bitcoin treasury adoption haven't yet passed. But the fact that these shareholder resolutions are emerging signals a shifting tide. Bitcoin isn't just on the radar, it's on the agenda.
Effectively, it depends which approach they're using. So you can see MicroStrategy, they're quite transparent that they're learning. So they start with one strategy. So when they started, they used their treasury. Firstly, they did a share buyback offer so that people didn't believe in it could leave. So they bought them back at premium. Most people stayed. They bought their first slug of Bitcoin with cash, and then they ran out of cash.
Yeah.
Plus or minus, right? And so the next thing they did is took a corporate bond. It's a long-running company with steady revenue, so they had a credit rating to bring in a big corporate bond. They built up a debt ratio, and so they were quite aggressive into their first bear market. So when the price fell, they did more, right? And they actually they overcooked it. So I went back and looked at it. I bought some of it in that bear market period, but I went back and looked at it in terms of how much debt they had versus the net asset value of the Bitcoin. And the debt got larger than Bitcoin for 5 months in a row. So if that was a leveraged position on exchange, they would have been liquidated.
Right.
So now it wasn't, directly margin callable. They had the equity cushion, had plenty of revenue to pay the interest on it. So they just, plowed through it. They did something tactically interesting, which is they had at the tail end of it, like a 200 million collateralized Bitcoin loan from Silvergate.
Okay.
And Silvergate started to suffer in the market and they needed liquidity fast. So they actually bought back their own debt at like a 30% discount of Silvergate.
Yeah.
So that worked out well.
Yeah.
But generally speaking, I think you can see that they've learned from it, right? Because now they are targeting a conservative leverage ratio. And they also cleaned up the callability, so there's no direct lien on the Bitcoin.
Right.
It's restructured things, and they had, the negotiating power to do that. So it's in a safer position, and
But they're able to do that because of who they are. But what about all the new entrants that are?
Well, that's a very good question. So, there is a potential risk that some new entrants push it too far in like an attempt to catch up, or, getting a bit too exuberant and pile on straight debt that then they have difficulty servicing in a bear market, right? Get too high leverage. Now, some of them, like two of the ones that have a very high NAV actually have almost no debt, interestingly. So MetaPlanet has almost no debt, and OPG has debt, but it's Bitcoin basis debt. So the debt, if Bitcoin price falls, the debt shrinks. And so they never get into a kind of solvency issue with ability to repay, right? So, but yeah, you might see that in a bear market, that some people have made some kind of over exuberant straight debt structures that could, So I think one of the risk points is people looking at the big ones and saying, well, if MicroStrategy sold like 500,000 Bitcoin in the market, well, create a debt. I don't think that's happening because the debt ratio is low, and they got a lot of levers to play with, and a lot of the debt they have is convertible, right? And so they can, they're converting it as it reaches premium. So the debt that's left over when the market turns, which presumably will eventually, is it's manageable. And I think the other thing is, the average entry price into Bitcoin is like 65, some probably is gradually creeping up to 70. So they got some headroom from the 110 level,
right?
And the floor price, this 200-week moving average, is also creeping up, right? 47. Soon enough it'll be 50. So, and if that's an indication of, well, the market probably won't fall below that kind of region,
right?
There's a safety in that. But past history doesn't necessarily predict the future, also, right? So, and if the phenomenon gets big, it could contribute to the market dynamics in a negative way, I guess.
Yeah.
So, you just hope that the people that take the risk that goes wrong do it when they're small, so they don't have an impact on the market. Right. Or the other thing that occurs to me is that, a bigger strategy company could buy them. Well, I think, because what I was saying about the scalability of the approach, I think eventually it will pull in some of the larger cap companies because, there is literally a fiduciary obligation to protect their shareholders' interests, and some of these companies are sitting on like $1 billion plus of cash, or probably more, right? 10 billion or something.
Apple, billions.
Yeah, right. And so, realistically, with the M2 monetary expansion and the debt ratio in the major economies, we're probably facing, a decade or two of financial repression, which means that the inflation rate is higher than the interest rate.
Right.
And so if they have 10 billion or more sitting in US treasuries, they're just straight up losing it. Right. And so that's not, Warren Buffett would say cash is king, and he's waiting for an opportunity in the market, and he's good at waiting for the bottom of the market to go buy stuff.
Yeah.
But in the meantime, why is he losing money on the cash? Right? There's obvious alternatives. So I think some of the sort of more technology-focused companies with younger management will probably start to get there. You've seen a couple of shareholder requested votes for the boards with Microsoft and Apple. It didn't get passed, but the question is coming in. And there are Bitcoiners in there. I know some ex-Microsoft people on the top management or on the board who are Bitcoiners, right? And so there are people around them that understand Bitcoin, have been at Bitcoin for a while, who would, try to explain it to them.
Yeah.
Adam Back's insights provide a masterclass in Bitcoin-based capital strategy. He isn't just promoting Bitcoin adoption for ideological reasons. He's identifying a massive, untapped arbitrage opportunity at the intersection of corporate finance, monetary policy, and macroeconomic distortion. This is not a retail game. It's not a flash-in-the-pan trend. It's a decade-long structural shift that may end up being the most important capital rotation of the 21st century. If companies continue to execute responsibly, we're likely to see Bitcoin adoption not through consumer apps or ETFs alone, but through the strategic redeployment of trillions in idle corporate capital. So the next time you hear someone say Bitcoin is only for retail speculators, send them this video. Because what Adam Back is describing isn't just the future of corporate finance, it's the roadmap for the next phase of global monetary evolution. Please like and subscribe.